Hey guys, John Brown here with Explore Park City Living, associate broker with Keller Williams Park City, and Trump just dropped a $200 billion bomb on the mortgage market, and we're going to get into it. This could affect your rate, your timing, and your next move to Park City, but is it real impact or is it just a short-term pump? Let's talk mortgage-backed securities. And what Trump just did was $200 billion announcement, which actually means Trump just directed Fannie Mae and Freddie Mac to go out and buy $200 billion worth of mortgage bonds, mortgage-backed securities. The idea is to lower mortgage rates, lower monthly payments, and make homes more affordable. It's a move straight out of the 2020 playbook during COVID, but here's the catch. They don't have the money. Fannie Mae and Freddie Mac together have about $100 billion in assets, total assets. That's cash and cash equivalents. Fannie Mae actually has $12 billion in cash and $27 billion in cash that's already kind of like accounted for in other deals. And then Freddie Mac has about $4 billion in cash, but together in cash and cash equivalents assets, they have about $100 billion. But that's only a fraction of the cash that's needed. Freddie's in the same boat, so they'll need to issue debt, essentially borrow money to go shopping for these bonds. That's where things get a little tricky. Issuing that much debt could raise concerns about inflation, which pushes rates up, so the outcome isn't guaranteed. And when I say that inflation could be pushing rates up, you have the 10-year treasury, and then you have mortgage-backed securities. So mortgage rates come at a spread off of the 10-year, so buying mortgage-backed securities can lower that spread, but then the thought of issuing debt to buy all that is inflationary, which might bring the yield of the 10-year up. So your spread might come down, but then the 10-year yield might go up, so rates might still come down, but not as much as you would think when you're buying $200 billion of mortgage-backed securities. It's kind of a give and pull, and the free market is actually going to be fighting back the issuing of debt to buy mortgage-backed securities, because then people will buy the 10-year treasury less, so less demand on the 10-year treasury, the yield will go up, and that's what mortgage rates go off of. So it's a little confusing, but all in all, it's like if Trump announces this, the free market's going to fight it. Just like how 10-year treasury keeps going up every time the rates drop. We're not going to get into that, but anyways, this could still drive a mini refinance boom. So think of a dip maybe 1/4 to 0.5% on rates. The sweet spot could hit between February 8th and February 22nd for that refinance boom. That's when you might see the dip before the market recalibrates. If you're a homeowner looking to refinance, you'll want to track daily rates. Look for the 0-point rate dropping into the 5.5 zone. That's the Goldilocks zone. Also, when I say the 0-point rate, that is the rate that there is no points to get the rate. So you could always say,
hey, look, I want a 5% rate.
They're like, okay, fine. Yeah, but that's going to cost you 4 points. And then that cost is up front. If you look out 30 years, that could save you money down the line. But in reality, most people hold their mortgages 5 to 10 years because they either refinance, sell, or pay it off. And when you're paying up front for a better rate, but then you only have the mortgage for 7 years, you're paying more out of pocket to get a better rate. But if you just, that cash that you paid out of pocket, you only get back 10 years later, right? And then that last 20 years of the mortgage, it compounds. But like, you're usually not going to be holding that mortgage for that long. So I don't like paying points on rates, especially on refinancing. I actually take a negative point. So I get a little bit higher of a rate, but the refinance is free. I don't have to pay $5,000 for this refinance or 10 or whatever it is, because actually refinancing costs money, and then the points are additional money on top of that. So paying all this money to get a lower rate that you only see the benefits in 15 years, and then you sell or refinance in 7, just comes out of a net negative. So how I'm thinking about this is I'm getting ready to refinance. I have a 7% on one of my houses, so I'm going to refinance this house I'm currently in right here. Probably going to do that, and I might take a negative rate, might take a little bit higher of a rate, just so I don't come out of pocket to refinance. And so if rates come down in the future, I can refinance again without being like,
I'm losing out because I already paid X amount and I need to hold that X amount of years to recoup the money I came out of pocket to pay for the refinance.
So with all that being said, don't get caught in chasing the teaser rate. That costs 4 points up front, like I was saying. And if you're thinking of buying in Q1, this little dip could spark just enough buyer activity to give sellers confidence. So you might see less negotiation power as these rates drop, but more inventory might hit the market heading into the spring. So you just got to see your pocket. Park City's over 60% purchases are cash, so rate drops don't change affordability as much as they change momentum, but momentum drives deals. So there are opportunities with this. A $200 billion announcement is more of like this vote boost headline than long-term solution, but it could create windows of opportunity in the next 4 to 6 weeks, especially if you're being strategic. So if you want more information and insight like this, give me a call, 801-837-4445, or shoot me a text. My info is in the description, and stay tuned weekly for more videos giving you perspective, views, and education on Park City and Salt Lake and the real estate market. See you guys. Thanks. Bye.